Welcome back to part 2 of your pre-scene. I hope you're clear with part 1 and I hope you very well understood every single thing that I taught in part 1, because obviously you'll have to carry on that knowledge. You'll have to keep hold of that knowledge while we go deeper into the pre-scene and speak about all the details of our company's processes of retailing, what departments we have, and then finally reach the financial analysis as well. All of that is planned for you, all of that is prepared for you, but you'll have to have a good understanding of the industry analysis. That was the first video. Then we have pre-scene analysis part 1, which you must go through, and then you can start with this video only when you are comfortable with the part 1 and the industry analysis. So up until now, we have done the introduction of our company where they tell us we are a quoted toy retailer listed on the stock exchange and we deal in West area, which is a strong economy. Your role is that of a finance manager. Then they started to speak about the toy industry, telling you what the categories of toys are. So we spoke about action figures, arts and crafts, building sets, electronic toys, non-electronic toys. We spoke about infant toys, plush toys, vehicles. We spoke about all of that and we had done a very detailed analysis linking it to different parts of your syllabus areas of E2, P2 and F2. Then they specifically started to speak about the Westarian retail toy market. In Westaria, what kind of retailers are present? So there are independent retailers, then there are toy shop chains like our company, Happy Playz. Then there are catalog stores, only online retailers, and then supermarkets as well. After that, they started to speak about the relationship of retailers and manufacturers. And while speaking about that, they told us about the nature of the industry being seasonable, having licensed products. So, all of that was dealt with, and all of that was something that we spoke about. Keeping that in mind, we are moving specifically to part 2 now, where we will discuss deeper and further into the insights. So let's begin with part 2. The first thing that part 2 starts with is licensed products. So licensed products are, so most categories of toys can be linked to a licensed image, such as a character from a film, television program, or a book. There can be simple as coloring books with pictures based on a storyline from a movie. All of us have seen that. Or it can be a vehicle which is modeled from a film. We all know what a licensed product is. We may have seen it, used it. So film and television producers and book publishers can earn a significant amount of royalty if their product gets licensed. So there have been many successful toys based on such licensing agreements. We already know that. Retail toy sales follow an annual cycle. Very important direction being given over here. Toys sell steadily, albeit with some volatility during the first 3 quarters of the calendar year. The fourth quarter accounts for roughly 50% of the annual toy sales by revenue. So it's very clear that majority of your marketing, majority of your inventory should be at its peak while we approach the fourth quarter, which is the end of the year, because that's when there's a holiday season, that's when people are gifting each other things. So careful time analysis will be very important and very necessary, along with proper management of resources, proper management of employees, proper management of inventory. This is part of your E2 syllabus. Traditionally, Westarian children receive expensive toys as birthday gifts and also during the fourth quarter holiday season. So marketing around this time will be vital, will be very important. The fourth quarter holiday season drives much of the activity in the toy industry. Manufacturers are usually keen to launch new products in this time in order to maximum benefit from consumer spending. Retailers, on the other hand, are keen to identify the toys which are going to be most popular so that they can buy as much as possible, and so that their rivals don't buy that same product in that huge quantity, and so that they can sell and make a profit. It's as simple as that. So for our company, for Happy Playz, it becomes very important to identify products which we feel are going to sell the most. So the use of data will be very, very important here. If you don't have past data as to what is selling the most, what is the genre that is selling most, how will you even purchase? What will you purchase? So if we don't have past data of genre of games that are selling, how will we forecast and stock accurately? So data is a very, very important step in this process. This is your P2 syllabus. Also, short-term decision making, risk-related decision making again comes into the picture because of these seasonal variations that we are speaking about. Again, part of your P2 syllabus. So having knowledge, insights about your company, having knowledge, insights about the market trends is very important in this business if we want to stay ahead of our competitors. Now we have a supplementary reading section for you. So while reading the pre-scene and while doing the pre-scene up until now, I've been repeatedly mentioning data analysis, big data, because it is one of the most important aspects for any retailers in today's modern world. Because if you don't use data, if you don't know the full potential of data, how will you exploit the opportunities in the market? So what we have done is, apart from the pre-scene, going away from the pre-scene, we have added an extra 2 pages here as supplementary reading, as an extra example for you to see why and how retailers are using big data in this modern world. Let me show it to you. So big data and analytics brings additional value for retailers. Let's take the example of Black Friday sales in the US. For many people, it's just a chance to buy TV, fridge, or whatever. But for parents, gift givers, it's the best opportunity to buy specific, special, sophisticated toys at a good price. Year after a year, toys come out as a top product category of Black Friday weekend. In 2020, Walmart made a huge $44 million in this weekend alone. So if you have not stocked properly, if you don't have good inventory, if you don't have good knowledge of the demand in the market, how will you make this amount of sale? So for this to happen, data is very, very important. It means retailers face the difficult challenge of predicting what the biggest new toy trends will be, forecasting the sales, putting the measures in to ensure supply meets the demand, and the challenges remain the same every year. How analytics will help you is by knowing what customers want, what they're looking at, what price point they're buying at. So analytics is helping retailers seize control of an unpredictable market. Let me give you some unique insights. So like all retail industries, toy retailers can use analytics to better understand your stock shortages and predict the demand. For example, Amazon ranks products based on available inventory, how its customers have engaged with the products in the past, and how the product fits with its current purchasing trend. If you don't collect this data, how will you know what is needed? So many toy retailers also use big data tools to make price comparisons in real time over the holiday period, ensuring their stock is being sold at the best competitive prices. However, see, big data, I showed you why and how it's important in the real world. But there are some challenges as well. For example, slow development times and unexpected consumer responses means it's incredibly difficult to accurately predict. Data will give you everything, but do you think it will be accurate? 100% accurate? No. So just look at Disney's Frozen, for example. When the film unexpectedly became one of the biggest movie hits of all time, parents were fighting to get a hold of limited merchandise supplies. So even after predicting as much as you want, there will be some cases where you just can't do anything. You need to get lucky, or you need to be in a situation where you are ready to pounce when the opportunity arises. But yes, data gives you a better chance. Why am I telling you all of this? Now, one of the greatest strengths of market leaders, any market leaders, has always been that they don't wait for competitors to come along and disrupt the business. Digitally disrupting the business should be something that your business is known for. One way is big data. So some of the market leaders' efforts have paid off because thanks to all the data collected and the massive investments in big data, the top 5-6 brands have become the largest and most efficient companies in the world. For example, Walmart, now Toys R Us, now they have Amazon as well. Why am I telling you all of this? Point of all of this is that our company Happy Playz can do the same, and nowhere in the entire pre-scene have they mentioned that we are harnessing the full potential of data. So we are a big retailing company in West area and have been in this industry for a very long time. So this could be something that is a huge opportunity for us, and I proved it to you with this supplementary reading and this extra example that I have presented. So remember, this example is something extra that I presented for you to show that big data is the way forward in any retailing industry. So now when you go to the exam and you're writing anything related to data, you're writing anything related to expansion, stocking, inventory, use this as a suggestion and say that big data can be used. It's being used by the top retailers in the world, in the market. So we as Happy Playz can also use it. All of these ideas I'm giving you so that you can write a better integrated answer. So make sure you keep it in your mind. Make sure you go through this again so it sticks in your mind, because it will be of no value if you can't remember it in the exam. So please make sure you're going through it carefully. Back to the pre-scene now. So after that supplementary reading section, we are back to the pre-scene. Frequently, one of the new toys launched at this season is in such great demand that retailers quickly sell out. It does happen, right? Something that you want, something that is related to a movie, and the movie becomes very famous. Toys go out of stock. That happens. Toy manufacturers exhibit their products at the annual Eastland Toy Fair every January. So remember, this is a different country that they're speaking about. We are in West area. Toy manufacturers hold this annual toy fair in Eastland. This is the largest and most important toy fair, so it provides an opportunity for retailer buyers to meet with the toy manufacturing marketing managers. Manufacturers demonstrate new toys that will be launched during the year and prototypes of toys which are under development. So it's very obvious that your purchasers, Happy Playz purchasers, will have to travel to Eastland to attend this toy fair just to make sure that the relationship with the manufacturers is maintained, and so that you can predict and see what toys are going to be launched and accordingly place your orders. Toy manufacturers also work directly with large retailers, including Happy Playz, because they need somebody to sell their toys as well, right? Marketing managers will aim to meet regularly in order to maintain contact and in the hope of securing orders. Now, the management of this relation will be key to secure manufacturers' inventory in times of high demand. So, your communication, your management of relationships, and your negotiation will be very, very important. All three are part of your E2 syllabus, especially your negotiation method, your negotiation tactics will be very important, which is part of your E2 syllabus where the negotiation process has been explained. Retailers generally make initial commitments to order for the fourth quarter purchases at the end of the first quarter. So you're placing your order in advance. This enables manufacturers to schedule production, particularly for new products. So as you can see, the working capital cycle is going to be long here. The business cycle management will also be important, because something that you want at the end of the year, you are placing an order for at the beginning of the year. So your money is getting stuck, that you will have to pay the retailers in time, right? So your money is getting stuck and you'll only be able to sell this product at the end of the year. So the management of the working capital, your cash flow analysis will be very important. When we go to the financials, we'll see what the cash position of the company is like. In addition to ordering in advance for the fourth quarter, retailers place regular orders throughout the year to replenish inventory and to acquire any promising new toys that will be launched before the fourth quarter as well. Retailers must also prepare for the summer months when most outdoor toys are sold. Licensed toys create opportunities for both manufacturers and retailers, and these can generate substantial revenue, as we all know. Demand for licensed products usually peaks in response to the publicity for the launch of a film, television program, or a book which it's based on. Manufacturers who have licenses will seek orders from retailers long before the launch, so they should know how much they can produce or how much they should produce. So this is further evidence that the demand conditions will be good in this market, which means you will have to make sure that you look at the demand in the market, place the order, and since you are part of a promising economy, developed economy, which is West area, you can expect a good demand on products like these, even if they are a little bit on the expensive side. Typically, retailers will wish to have toys in inventory for 6 weeks before the launch, so that your promotion can happen and merchandising can happen. It can coincide with the film. So these are your key points that you can market on as a retail business. I have products which are licensed. I have products which are sophisticated. We have it in stock. We are ready to sell them. These are ideas that you can have from the marketing perspective as well. Licensed toys can form several different categories, so a major release can offer a welcome boost to demand during the quieter times of the year. But yes, obviously you have to predict, you have to go that one step ahead to understand what will be required, what will be in demand, and have a good relationship with manufacturers to make sure you have that stock as well. Now finally, we arrive to speaking about Happy Playz's business. So up until now, we were doing a whole market analysis, toy industry analysis, the West Arian retail market. We spoke about all of that. But we had not spoken about our company. What is the base of our company? What is our company? How is it positioning itself? What are the core values? None of that. That starts now. So we start with Happy Playz's business. First thing is history. Happy Playz was established in 1992 when its founders opened the first Happy Playz store in West Area's Hope City. So business started in 1992, right now 2022. So 30 years the business has been in the market. Now let's just think naturally. Have you seen any business, and I mean any business, that exists for 30 years and is continuously making a loss? People don't like their products for 30 years. Do you think a business like that can run? I don't think so. So when a business has survived for 30 years, it definitely means that people are liking the brand, people are liking the products that they sell, and which definitely means that there is some goodwill that has been garnered by that business. So, which means we have definitely garnered some goodwill and some resistance ability, that we have been able to thrive and grow during this period because our revenue is increasing. Every market goes through stages of booms and recessions in 30 years. In 3 decades, there is obviously going to be a dip or a market rise. And if we have survived in both during the growth phase and grown in that period, it says a lot about the company. But since we are speaking about being in the market for such a long time, there is going to be internally generated goodwill for your business. Now remember, internally generated goodwill cannot be recognized on the financial statements, but because we are speaking about the word goodwill, it takes me to the F2 syllabus, and goodwill related topics in financial accounting are quite important, and they have specifically spoken about this in F2. If not recognition of our company's goodwill, there can definitely be a question that comes up about recognizing goodwill of a subsidiary that you have purchased. What is goodwill? How is it recognized? These are often questions that come up, and hence when I see a trigger word, I'll try to relate it to your E2, P2 and F2 syllabus, showcasing to you that okay, these are topics that can come up in the exam as well. So we spoke about goodwill. Next, the founders focused heavily on promotion and merchandising. So these two things were being focused upon by our business from the beginning. The shop itself had a vibrant color scheme that made it visible even in city center shopping districts. So first shop that was opened was in city centers, and it has a vibrant color scheme. The shop concentrated on established and popular brands of toys, which were priced to match the lowest prices set by competitors. Remember, you are a retailer and not a manufacturer. So the toy you are selling is the same toy others are selling as well. So it's generally there is a need to match the price, and that's what our company did. Happy Playz aimed to offer a wide range of products than competitors, so customers could choose from a whole range of products before deciding what they want to buy. So this is a competitive advantage for our business, that I focused on popular toys, I matched the prices, and I had a wider range of products available on display, and my shop had a vibrant color scheme. These are comparative advantages for my business, right? This is what is setting me apart. Next, Happy Playz was quoted on the Western Stock Exchange in 2004. Company founded in 1992, 2004, 12 years later, the founders sold their interest in the company at that time. Now this is general happening for any startup or any business that is started by 2, 3, 4 people. It really booms, it really does well in the market, and then they get listed on the stock exchange, which gives the founders an exit route where they can sell their shares on the stock exchange and earn a good huge profit. Because to be listed on the stock exchange, you're obviously going to be a big company. So we can see that the original founders have sold their interest. This would mean that the equity has been redistributed between many shareholders. First, if I own 20%, now there might be five people who own different parts of that stake now. So the knowledge of the statement of changes in equity would have also been important at that time, and as a finance manager you should have that knowledge, because the structure of equity can always keep changing. So consolidation could be kept in mind because it is often asked. So statement of changes in equity, consolidation, part of your F2 syllabus, which I thought was important to mention here. And any topic around this umbrella can come up, and hence I've always tried to pick out the most examinable topics. Next, we must also keep the IFRS 11 joint arrangements in mind. They could simply tell me that we are entering into a joint agreement with this company for XYZ reasons. How will it be accounted for? What does IFRS 11 lay down? So you may be needed to provide that explanation. IFRS 11 F2 syllabus. Same way, IAS 10, happenings after the reporting period. So you should know that if, for example, we could acquire another company, in any scenario, they can say that today we acquired another company, and hence speak about events after the reporting period, events before the reporting period. How do we identify them and how do we account for them? Part of IAS 10 F2 syllabus straight away. So again, what I'm trying to do is bring out topics, bring out scenarios which do come up in the exam to give you thoughts that, okay, this is how I'll study the topic. This is how I'll do a revision of this particular topic. That's what I'll do throughout the pre-scene. Now they're telling us that since 1992, Happy Playz has positioned all its shops in out-of-town retail parks, relocating city center shops when necessary. So obviously city center shops may have a little bit more of a footfall, but the rent, the management, the upkeep turns out to be very, very high, and you also get a smaller space. So Happy Playz positioned itself to out of town retail parks. These are popular with customers because of plenty of parking space that it offers, and they are also located close to motorways. Happy Playz now has 120 shops in one country itself. So you can imagine the size of the organization. And to further the size of the organization, they have said that we employ 6,500 staff. Those shops are spread across West area. The company's head office is located on the outskirts of the West area's central city. It employs 140 staff in the head office. There's also a warehouse adjacent to the head office that stores inventory until it is required in the shops or to fulfill online orders. Warehouse employees are 240 staff. If I look at it as a breakdown, 6,500 shop staff, assuming these are sales, stock management, all of that for shops only. 140 head office staff, 240 warehouse staff, a total of 6,880 employees. Majority of our cost would be shop management and sales staff because they are 6,500, so their salary is going to be a direct cost for our business. Making sure it is a happy and efficient environment to work in is very important for our business. So communication management, conflict resolution, because there are so many staff, conflict is bound to happen between different levels or between different subordinates as well. That is going to be very important throughout to manage. And this conflict management, conflict resolution is part of the E2 syllabus. I'm getting another thought here. You'll see that only 140 people are given to manage the head office. They've not given us any breakdown here. So I will assume that head office includes everything except for shop and warehouse, right? So head office includes IT, HR, finance, accounting, marketing, sales. All of this is done by 140 people. IT is ever growing in this digital world, and with app management, which we may expand into, or website management that we are currently owning in line with our development strategy, and with further IT improvements, do you think this amount of employees can suffice for this important head office job? Similarly, innovative marketing and sales techniques are being promoted all over the world. If these 140 people are under unrealistic pressure, they will not be able to perform and meet the goals of the organization. Also, the finance function is ever evolving, ever demanding. If unrealistic workloads are being implemented, it will not be to the long-term success of the company. So as the company grows, you may have to define head office staff in a better way, and you may need more departments, which we'll speak about later as well, to make sure that each department is given importance and each department actually has a say in the strategy of the organization. Because all of this, IT, HR, finance, accounting, marketing, sales, all of these are very important parts of any organization. So as at every step, when I find something good with the company, we'll note it. When I find something bad with the company, we'll note it. When we find exam scenarios, we'll note it, because that's the only way to learn about our company. Next topic is retail operations. Speaking about my company's retail operations. Now, Happy Playz revenue comes from the sale of traditional toys, but the company also sells video games, and a small range of children's bicycles. So the company is selling toys as well as complementary products like video games or children's bicycles. So the ideal place for all retailers, or the ideal situation for all retailers, is to make sure that they expand product inventories, because the more different kinds of products that you have, may it be complementary products like video games, like bicycles, the more people enter your stores and the more chance of making a sale. So when we are thinking about growth, when you're thinking about product development, new products, market development, new market, diversification, doing something completely different, we can relate to the Ansof's matrix here. And the Ansof's matrix is part of your E2 syllabus, and that is why I am bringing it up. Whenever you're thinking about growth, you can use the Ansof's matrix as a background, as a starting point for your discussions. Next, the company may not be able to compete with specialist video game and bicycle retailers, obviously, but its customers often expect to find such items on sale, so both sell steadily. Happy Places shops are laid out to encourage customers to browse and make their selections. Obviously, you want to set your store in a way that is easily accessible. So why is store layout important for a retailer? I will say that the layout of any store is very important for any retailer, because only then will the customer be enticed to look at things, maybe touch, feel, read, and then maybe choose to buy. So for any retailer, may it be the biggest furniture retailer, furniture seller like IKEA, may it be a toy retailer, may it be any retailer, in their store, a layout is very important, because it determines and influences the customer's shopping pattern. Whatever is easily accessible, whatever is in the first row, first aisle, eye view, is something that gets picked up more, so it influences the customer's shopping pattern. Obviously, having a good layout optimizes your available space. You may be able to have better racks, more stands for your games. It also creates a positive store atmosphere. For example, a too tall or a too low shelf can obviously make it difficult for the customer to bend or to go up and fetch their game. So layouting is very important, and it can provoke additional sales. So for any retail business, remember, layout is very important. Next, each shop has several aisles, each of which has racks of toys on either side. Shop staff are available to direct shoppers to the location of any given product. So your staff will also be important, because if somebody asks for help, the staff must be helpful, they must be enthusiastic, they must be ready to help. Staff are equipped with Wi-Fi enabled tablets that can assist in checking inventory and product specifications. If a customer asks, do you have this game? The staff can check the Wi-Fi enabled tablet and say that I have it in inventory, I'll fetch it for you. The staff are also expected to have sufficient product knowledge to enable them to advise customers and make informed recommendations. So staff are playing an important role in my organization. Now, there can be situations where they ask you to calculate the NPV or the IRR of a new project, a new store, a new warehouse unit, a new inventory storage unit that we may be expanding to. They'll say we're taking up a new project of opening up a new catalog store in this country. This is the NPV analysis that they have already done. Your job is to explain what that analysis means. They can same way give IRR, same way give payback, ask you to explain what it means. So your knowledge about these concepts from your P2 syllabus is very important. Same way we have 6,880 employees, brings in the question of responsibility, delegation, leadership styles. It can also bring in conflict related issues because of so many large number of employees. There is straight part of your E2 syllabus, And at every stage, we are pointing out important syllabus areas as well. Coming back, Happy Playz's website is used to promote products, including any special offers and promotions. So you're using your website as a promotion tool as well. Customers can select and pay for items through the website and can collect them from their nearest shop. Customers can also order goods online for home delivery purposes. Happy Playz warehouse acts as a fulfillment center for online sales for home delivery. So remember, customer can place the order online, he can then collect it at his nearest store, or he can get it delivered to his house as well. We are offering those services, let's put it that way. Warehouse staff pack and label the ordered goods, and a third-party courier company collects these online sales orders each evening and organizes delivery within 48 hours. Okay, so a very good thing is this part has been outsourced. You are not controlling the delivery by yourself. And what I think is, this means that the company is ready to outsource non-core competencies. Now, I don't think for my company, the core competency or the major job is to deliver goods to customers. I'm not a delivery company. I'm a toy retailer. So it's good that I'm using third-party couriers so that I'm saving costs. I'm not investing that huge amount in logistics, getting it done by an expert, by a specialist. So good, the company is accepting this mode of outsourcing non-core competencies. Now I'm mentioning this to you because when you are suggesting something which is a non-core competency, you can link it to outsourcing because that's what the company has done. Same way, the use of artificial intelligence and sophisticated sorting systems could be very important in our warehouses because that would enable quicker sorting, quicker packing, quicker order dispatch. It can be our competitive advantage. So another way the company can modernize its processes is by using artificial intelligence and maybe a better sophisticated sorting system in the warehouses. Now they tell us that each of Happy Playz's shops is managed as a profit center. Every shop that we have in West area is managed as a profit center. So what is the profit center? We need to think from our P2 perspective over here. Now when I see profit center, it takes me directly to the concept of responsibility accounting. So firstly, what is a profit center? A profit center is any business unit. So any shop in this case is a profit center because it has the responsibility of its own revenues and its own expenses. It's responsible for making sales and it's responsible for controlling expenses. That's a profit center. This center is based on the responsibility accounting principle, where managers, let's say a store manager or shop manager, will be given the responsibility for his shop. He has to show a certain amount of profit by making certain revenues, by controlling certain costs, and his performance will be judged on that directly. So it's good our company is using the responsibility process of accounting, which is a good, I'll say, a good concept to implement because it brings in accountability, brings in responsibility, and people will buy into the culture of the organization if they are made responsible of the entire revenues, of the entire costs, remember, which they can control. As we move deeper into the pre-scene, we'll see what type of control is set in the organization, what type of freedom is given in the organization. Only then a profit center would make sense. But if the manager has good control over the costs, over the revenues, then he should be judged on them. He should not be judged on something which is completely out of his control, because then it adds no value. So as of now, they're telling us that we run the business run each shop, as a profit center, which is a good place, a good sign, a good P2 relation that we have found over here. Now, shop managers are responsible for achieving the sales and performance targets that are set by the marketing department at the head office. So they're telling us that the head office marketing department sets the sales and the performance targets. They'll tell you that this is the performance, this is the key performance indicators, KPIs, and this is the amount of sales that you have to make. That's what they'll tell the managers or the shop managers, whatever you want to put it. So, but this is set at the head office. Now, this paragraph and some of the information given here mentions the use of a top-down approach, where your system performance, where your sales targets, where your budgets are set by the top management, and then the lower level or the management level employees simply follow the same. They say that shop managers are responsible for achieving the targets which are set by the head office. So somebody else is setting the targets and somebody else is simply following them. So this shows a top-down approach. On the other hand, there is a bottom-down approach where the shop managers would be involved in the target setting, in the KPI setting, and obviously they'll buy into that method more, right? So currently our business using top-down approach. One way the business can go forward is bottom-down approach, and a definite exam question revolving around KPIs is very much possible, and I've pointed the same out to you as well. So over here, let's just sit and think. Couple advantages of the top-down approach, couple disadvantages of the top-down approach, couple advantages of bottom-down approach, managers being involved, and couple disadvantages of the bottom-down approach. This is your E2 syllabus, and also the KPIs that will be set here will be very important. Let's think about the KPIs relating to the sales metric here, which the managers could be given as a target. This is part of your P2 syllabus. I've given you some food for thought. I am going to do a KPI related question, and I am going to ask you KPI related insights. But right now I want you to think. Pause the video here. Think for a couple minutes. Think what kind of KPIs could be set over here. And then I will be giving you discussions. I will be giving you answers relating to the same at a later stage. But right now I just want you to start the thinking process. That's why I have mentioned this. After that, they tell us that shop managers have limited discretion, but it has been noted that the competence and enthusiasm of individual shop managers can have a significant impact on the performance of their shops. So first they told us, I'm seeing an interesting trajectory here. First they told us that we have set each shop as a profit center, which means responsibility given for revenues, for costs. Then they tell me that targets are set by head office. After that they tell me that shop managers have limited discretion. Now what's the point of a responsibility accounting system where they have limited discretion, where they have set targets from the top? It won't be a very useful system. So there has to be a little bit of a change in the culture of the organization, and that is what they're telling us, that it has been noted that competence and enthusiasm of individual shop managers, if they buy into the process, can have a very significant impact on the performance of their shops. So they're telling us that they noticed that participation, managers buying in, managers being enthusiastic, managers supporting the organization is more useful for the organization. How? Pricing decisions are made centrally by head office, but Happy Playz gives shop managers the authority to reduce the selling price of specific items in response to local competition. If a local competitor is offering a particular toy at a discount, then the shop manager can create a special offer to match or even undercut that competitor's price. So they have limited discretion, but in certain situations this leeway is being given only because of an enthusiastic shop manager, a competent shop manager who wants to compete, who wants his responsibility center, his shop to do well. So participation has its benefits. That's what's being shown over here. Sales volumes can be increased through the supervision and encouragement of shop staff. If your sales staff are motivated, if they are ready to serve, then more customers may want to buy a product. And also, if shops are kept neat, tidy, clean floors, and fully stocked shelves at all times, it gives a good perspective of your shop. Next, shop managers can also draw upon their knowledge of the local market to enhance sales through merchandising. For example, the manager of a shop in a seaside town might create a display of beach toys in a prominent position close to the shop entrance so that it sells more. But again, it's only possible if there is a conversation between the shop managers and the head office. Vigilant managers can create systems and impose performance standards on staff that minimize your inventory losses due to theft, due to damage. Ensuring that staff are active and engaged will discourage customers from shoplifting while encouraging legitimate customers to make purchases. So, all in all, a little bit of flexibility has been awarded to the managers here, but it would be more beneficial for them to be involved in target setting, right? That's my thought process here, because then they can't complain that this target is unrealistic, because they are part of setting it. So when I'm thinking about target setting, it brings the performance of managers into my mind. And when I'm thinking about performance, appraisal of store managers, how did they do at the end of the year? Not only from the financial perspective, but from the non-financial perspective as well. A very realistic question, which is the balanced scorecard, can be asked. They can tell you, now we are looking to manage performance of store managers through the balanced scorecard method. What does the balanced scorecard mean? Can you please explain? So knowledge of the balanced scorecard from your P2 syllabus becomes very important, because without that, you can't answer the question, right? Next, shops opening hours are set by the retail parks who lease the properties to Happy Playz. So you are leasing the property where your stores are located from retail parks. So directly brings in IFRS 16 from the F2 syllabus, which is the leases part. It's going to be a very important IFRS to know in this case study perspective specifically, because a lot of lease mention has come up, and I'll also be making a discussion on them, and obviously we'll also be solving a mock question on it, but your revision direction is being given here right now. Most require the tenants to be open from 9 a.m. till 9 p.m. 7 days a week. Each shop has a manager, 3 assistant managers, and a number of sales assistants who are responsible for operating tills, advising customers, and replenishing shelves. Standard information. Each shop has a staff rota that ensures that nobody works for more than 8 hours. The rota changes from week to week, so staff must be flexible in terms of working hours and working days. The rota adjusts staffing levels to take account of expected customer numbers. Shop managers and assistant managers must also work on a rota basis with at least one present during shop hours. When the shop manager is absent, then one of the assistant managers is designated as being responsible for running the shop. Very straightforward information being provided up until now. So we spoke about the retail operations of our organization, how the retail operations are run, what the organization dynamic is. We also spoke about that, and throughout the way also introduced parts of your E2, P2 and F2 syllabus. Next aspect now is the management aspect. How is the company managed? Very important, because for a retail business, there's not going to be any manufacturing process or anything like that you need to know, correct? It's a retail service business. So service oriented businesses, the main thing is management. The main thing is offering your service. That's what we are speaking about throughout the pre-scene. Now, each shop manager is in frequent contact with Happy Playz's head office. Obviously, he has to be in contact. Revenues are recorded through the electronic point of sale systems in each shop. These transmit data to head office at the close of each business day. The accounting department at head office collates this information and supplies shop managers and the marketing departments with regular reports. Now I'm thinking over here that we could have a specific contract for the supply of games, maybe to a school, let's say for example, maybe to a nursery, maybe to an office, to any customer, where revenue recognition could become an important topic of discussion. They may ask you, we have to supply this much in this year. This is how it will be supplied. How will the revenue be recorded? So your revenue IFRS from the F2 syllabus is vital for your revision, because it is an exam favorite topic. It is a topic that often comes up in the exams, and that is why I mentioned it for you. Next, staffing levels at each shop are set by the human resource department at the head office. So pretty much everything is happening at the head office. But the irony is that there is a profit center which is responsible for the entire costs, the entire revenues that the particular shop or the center generates. So a little bit more shop manager feedback, shop manager inclusion in target setting, in staff setting is important as the business goes ahead. So human resources recruits staff to fill vacancies at any point of the time and advises on any HR matters such as staff grievances and disciplinary matters. So your conflict related problems are dealt with. The property department at head office, organizes all services including shop cleaning and maintenance. Facilities management will also organize a local contractor to carry out routine maintenance and repairs. Happy Playz owns the furnitures and the fittings in its shop. So IAS 16, property, plant and equipment, you own the furnitures, you own the fixtures, you own that equipment that your shop has, the racks, or where where your games are stored, the furniture, all of that is part of your assets. The company is also responsible for most maintenance and repairs to buildings. Now they have told us that we lease these properties, right? And now we are responsible for maintenance and repairs as well. So this would mean that there is an existence of a finance lease. The difference between finance lease, the recording of a finance lease, the recording of an operating lease should be known over here, which is IFRS 16 leases, straight from your F2 syllabus. A lot of mention on leases in this pre-scene, and a very realistic exam question could come up. Moving on. Charges for utilities such as electricity and local property taxes are invoiced to their respective shops. Shop managers check the accuracy of any meter readings and forward the invoices to the accounting department for recording the payment. So there is evidence of a very centralized traditional structure that is in place, where everything is running through the head office. It's more a top-down approach which is being followed over here, which is being observed over here by our company. Next, Happy Playz's head office is divided into the following departments. So the head office has some departments. We'll speak about each department, and then they'll give us the organization structure as well as we move deeper in. Firstly, let's take each department one by one. First department is obviously the buying department. We are not a manufacturer, we are a service organization, we need to buy, use our margin and sell. So what is the buying department responsible for? So the buying department is responsible for evaluating new products and deciding which products to buy, which should be purchased. Now this is arguably one of the most important jobs of a business of our kind. You don't buy the right things, nobody's going to buy them from you. Your customers are not going to buy them from you. So one of the biggest, important parts of this organization is the buying department. Happy Playz buyers attend toy fairs and they visit manufacturers all around the world. They study trends in the toy industry and work to ensure that Happy Playz can offer the latest and the most attractive toys. So your buyers, the people who work as buyers in your organization, finding them, holding on to them, will be seen as a comparative advantage in this market. If, for example, I am a buyer for Happy Playz and I have always, in the history, the products that I have bought are always been successful, have not created huge losses for the business, then my experience becomes invaluable for the company, right? So one of the comparative advantage of this business will be to find and then hold on to these expert buyers who will buy the right product for you to sell. Some toys are branded and trademarked and so have only a single unique source. You can only buy them from one place. Other toys are generic, and over here is where the game changes, where the buying department has to choose a specific product from many different competing brands and versions. It may be the same product, but different people are selling it under different names with slight variations. So which to buy, at what price point, at what quality is something that the buyer will have to judge from his experience. So buyers must take price, quality, and then obviously delivery into account when deciding on the purchase of a generic product line, such as unbranded plastic footballs. Plastic footballs are plastic footballs, but different companies make them with different quality, different prices, different designs. That's where the buying department comes into the picture. The buying department's responsibilities are limited to deciding which toys to buy. They only decide you buy this, this, and this. Ordering is then handled by the purchasing department. So the order placing is going to happen with the purchasing department. The buying department only decides that this is what we have to buy. It will be important for buying and purchasing to work in tandem. If both don't work together and have very rigid, very rigid jobs that you only have to do this, you only have to do this, without any collaboration, it's going to be difficult. Their KPIs and goals should be interlinked to make sure that they work together and there is no dysfunctional behavior, which means one department doesn't think only about themselves. They should think about the overall organization, and that can only happen if there are goals and KPIs which are interlinked. Now, dysfunctional behavior is part of your P2 syllabus, and that is why I have mentioned it. So remember, buying and purchasing have to work together if our organization is to do well. We spoke about buying, we'll speak about purchasing now. The purchasing department is responsible for placing orders with the manufacturers, many of whom are based overseas. So where we place the orders with the manufacturers, they are based overseas. This means that your F2 topic of foreign exchange risk, foreign exchange management comes into the picture here. Now, a scenario that I'm thinking of is if you are always buying from a foreign land, means you're paying in a different currency. Foreign exchange risk could be something that is out of your control pretty much. So what a scenario that I'm thinking is that we may have a buying department placed in another country. For example, majority manufacturers are in China. For example, let's say that Happy Playz sets up a buying department in China itself. So that company, that subsidiary, buys from the Chinese manufacturer, takes the holding of the goods in their own warehouse in China, and then it transfers it to Happy Playz in Westeria. This would mean the evidence of a subsidiary, firstly, which brings in your consolidation topics, and secondly, when the transfer takes place from the subsidiary to the parent, it could raise the question of transfer pricing, and that is how maybe they can ask you transfer pricing related questions. So your P2 syllabus of transfer pricing and chapter of transfer pricing becomes very important here. What are the different transfer pricing options? Why transfer pricing is done? What is transfer pricing? The reason for transfer pricing is very important and has been clearly mentioned in P2. So your chance through a scenario to just revise the same. Obviously, we'll do a mock question on it, but this is a scenario that came to my mind because they mentioned the term overseas, and this is happening in the real world as well. So I thought it's best for me to mention it. So transfer pricing, a scenario, and remember we buy from manufacturers who are based overseas. So your consolidation topics coming into the picture as well. Major toy manufacturers employ account executives to maintain contact with retailers. The staff in Happy Playz's purchasing department place orders through the account executives at the manufacturers. The purchasing department buys branded and generic goods that have been chosen by the buying department. Whatever, if it's branded, they buy it. If it's generic, they buy it. The direction has been given by the buying department. The purchasing department decides the size of the orders for new products and replenishes inventory as and when it's required. Now, negotiating with your suppliers, which means the manufacturers, as you are a retail business, you'll have to negotiate to get the best order quantity, to get the best order price, and your negotiating topic from the E2 syllabus again coming into the picture over here. So we spoke about buying department, we spoke about the order placing department. Now we are speaking about the logistics. You placed your order, then what? It has to arrive to you, right? That's what is handled by logistics. Now inventory has been ordered by the purchasing department, which is delivered to the Happy Playz warehouse. The logistics department is responsible for managing inventory after it has been received. Remember, we have a large number of shops, so it has to be distributed amongst the shops where the demand is highest, where X product is selling the most. You'll obviously want to send that product to that shop. All of that is handled by the logistics. Happy Playz frequently receives deliveries of toys that are not to be sold until specific launch dates. I receive it now, maybe only I have to start selling it from 31st of December. That can happen, right? So this would mean that a good amount of capital is committed to inventory, capital management, cost of raising new capital should be kept in mind here, which is F2 syllabus straight away, where they can ask you what are the ways for us to raise capital through equity, through debt. F2 first 2-3 chapters only speaks about capital management and cost of capital. So an important scenario. Another scenario, when we are raising finance, we should also keep in mind IAS 33, how the earnings per share will be affected. How, if it's a rights issue, what does it mean? If it's a bonus issue, what does it mean? If it's a convertible bond, what does it mean? You don't need to solve any sums. You just need to know what a rights issue is, what a bonus issue is, how it works, what a convertible bond is, how does it work. Part of your IAS 33. Again, F2 syllabus. And since overall we have been speaking about capital, the weighted average cost of capital situation also comes in over here. What if we take on more debt? What if we take on more equity? How will the weighted average cost of capital go up or go down? What does the weighted average cost of capital mean? These are all exam favorite questions that I'm speaking about, which is part again of your F2 syllabus. So please don't overlook any of this when I'm speaking about syllabus areas, when I'm pointing out exam scenarios. It's because they are important, and that is why I'm going through the pre-scene in such a detailed way with you, step by step, not missing out on anything. Those dates are set by manufacturers. The dates when you can actually start selling are set by manufacturers and are usually timed to take the greatest possible advantage of the release of a film if it's a licensed copy, or an advertising campaign if they've already planned for it. So Happy Playz takes delivery of such products to assist manufacturers with their own logistical problems and also to be certain that the goods are available in time. The warehouse is also used to store supplies of toys that have been purchased in bulk in readiness for the fourth quarter selling period. Having inventory to hand ensures that popular toys are available for sale at that busy time. So inventory investment is important for our business, but it's also a drain on our capital resources. The logistics department organizes deliveries of inventory to shops across West area. Happy Playz pays third-party haulage companies. Again, our home delivery handled by third-party, our internal movement of goods handled by a third-party haulage company. The logistic department also manages the packing and dispatch of goods that have been sold online. Okay. Next department is the marketing department. Now the marketing department sets sales and performance targets for each shop. We already spoke about that. It is the shop manager's responsibility to then achieve those targets. But is he involved in setting of those targets? I don't think so. There's no evidence to suggest that. So obviously there's going to be a gap between what is being set and what the manager thinks is achievable. Could create conflicts. The marketing department uses data provided by the finance department to provide each manager with a daily report on sales revenue, monthly report on revenue, and operating profit. Further oversight and support are provided by the regional sales managers. There are 5 regional sales managers, each of whom is responsible for overseeing sales by each shop that are located within their allocated geographical area. Each region has between 22 and 26 shops, and there are 5 regional managers. So 5 regional managers, each manager handling about 22 to 26 shops. They give guidance to the individual shop managers. So the individual shop managers directly speak to these regional managers. These regional managers speak to the marketing department. That's how the trajectory is. So the porter's value chain could be thought about over here, because our business's core area of marketing is being given a lot of focus, and that is true for retail businesses. So the porter's value chain sets out activities which are core values and non-core values. Marketing is one of the core activities of our business. So the value chain is something that you should know. Regional sales managers have access to sales data for all shops and are in frequent contact with individual shop managers by phone and email, like I told you. They also make regular visits to shops to make sure that the presentation and merchandising of toys is good. Marketing department is also responsible for managing advertising activities through both media and company's website. They are a marketing department. They have to look after marketing. Advertising usually focuses on the Happy Playz's name. So we are advertising on our brand. We are advertising on our name, because customer knows when he comes into our shop, he's going to get a good variety, a good quality at a good price. But the company also advertises a selection of toys in conjunction with the name. So this toy available at Happy Playz for a limited time. For example, toy manufacturers are usually keen to have their products featured predominantly and prominently in any promotional material. Now, managing this cost will be very important to maintain our profitability and our margins. The topics of sensitivity analysis comes into the picture here. What if we have this marketing campaign? What will be the effect on our cost? What if this happens? What will be the effect on profit? What will be the effect on margin? So what happens to profits or margins if one variable changes? This can be an exam scenario. So sensitivity analysis from your P2 syllabus, important. Also, they can have payoff tables. Payoff decisions can also be tested around this aspect. So your P2 syllabus is quite important when it comes to risk, when it comes to forecasting, when it comes to sensitivity analysis. It's quite an important area and an important segment. After marketing department, we come to the next, which is human resources department. Your organization has 6,800 employees roughly. It needs a human resource department to deal with all of these different employees. So the human resources department is responsible for the management of all aspects of human resource management, including recruitment, training, and retention of staff. Human resources is based at the head office, but the department also supports branch managers. Applicants for jobs in Happy Playz shops submit their applications to human resources. Those who meet Happy Playz standards are interviewed by means of a video call to a recruitment specialist in human resources. Staff who work in shops and in logistics department are paid on an hourly rate. We must make sure that that rate is fair, in line with the standards of the set by the government, to make sure that we are not exploiting anybody who works with us. It's big reputational damage if that comes out is something that our company is following. So newly appointed staff are placed at a point of scale according to their age and experience. Staff progresses up the scale each year until they reach the maximum of their grade. So pretty standard human resource department is one that we have. Then we have the property department. Now the property department is responsible for property management of Happy Playz shops, its warehouses, and its head office. The property department's responsibilities include facility management such as cleaning, maintenance, and legal issues associated with property leases. Happy Playz shops, warehouse, and head office building are leased, no ownership. The property department is responsible for negotiating the leases with landlords and ensuring that Happy Playz is complying with the requirements of the lease in regards of maintenance and repairs. The leases had an original term of 10 years. They have an average term of 5 years which are remaining. So now we need to look at a lease versus buy decision. Should we extend the lease? Or should we buy one of the properties, maybe the warehouse or maybe the head office or maybe one of the shops in a prominent location? So a lease versus buy decision here, where we buy the most profitable store or the head office as an investment, could be beneficial for us. And this is part again of your F2 syllabus. IFRS 16 lease versus buy decisions are quite important for any business as to if they want to invest, if they want to keep liquid cash. That's always an opportunity cost that needs to be weighed out. With that, we go to the IT department. We have an IT department, okay, but no mention of data analysis, big data, or data mining, artificial intelligence use. Nothing has been mentioned throughout, which shows that the full potential and the full commitment to IT has not been made. So the information technology department is responsible for maintaining and updating Happy Playz's IT systems. Information technology works closely with the marketing department in order to update the website, particularly the web pages relating to any sale or any promotion. And then we have a very standard finance department as well, which deals with all aspects of management accounting, financial reporting, and treasury management. So very standard set of departments that our organization has, which has been laid down for us over here, which we have discussed. Now we're speaking about the management structure of our company. So while speaking about the management structure, we already know that our company has a lot of very many different departments, and obviously each department is going to have a department head, is going to have a head which leads that department, and then the final direction comes from the chief executive, as you can see over here. So while speaking about the management structure, they tell us that we have a chief executive officer, a CEO, who is responsible for the running of the organization. So we have Magdalena, who is the chief executive officer, who is running the organization. And then under her, we have first the marketing director, who deals with buying department, purchasing department, and marketing and sales department. He deals with all these three departments, and his name is Jamil Ahmad. Next, we have Monica Junius, who is the operations director, deals with the logistics department, property department, and IT department. Next, we have QE Suping, who is the finance director, management accounting, financial reporting, treasury is obviously her remit. Then we have Eduardo Soto, who is the human resources director, staff recruitment, staff retention, staff training, everything related to human resources falls there. So what we see is the organization is set into very specific departments, and each director is looking after their own specific areas. So this is a very clear direction of a functional structure being in place, where there are different functions and each function is a specialization. Marketing director looks at marketing, looks at buying, looks at purchasing. Operations director, everything related to the operations of the company. Finance director, everything related to finance. Human resource director, everything relating to HR. So currently we do have a functional structure. Now as the business grows, we may need to have a different IT director, may need to have a different marketing and sales director if we are looking at diversification, if we are looking at coming up for an app for our organization, if we are looking to harness the full potential of big data. It may be the need, but right now it's under operations. IT is under operations. So it's a very straightforward functional structure, and seeing the image we can know that. Now a functional structure is generally recommended for smaller sized organizations who are working in a stable environment and don't have many different kinds of products. For our organization, we are not small, 120 plus stores. We are not working in a stable environment. Today's market is very dynamic, changes every day, specifically for retailers, and we offer many different kinds of products. So in the future, we could be asked to move on to a divisional or a matrix structure as our organization continues to grow. Why not? It's a very realistic thing that can be asked. Maybe a divisional structure or a matrix structure is something that they tell you that our organization is looking to move to the same. What is a divisional structure? What is a matrix structure? This is part of your E2 syllabus. It was also part of E1. That's why not heavily tested in E2, but also a mention which is important, and that's why I always like to point it out. Currently, functional structure, opportunity to move to the divisional or the matrix structure is there as the organization grows. They told us about executive directors, right? We had 5 executive directors, 1 CEO and 4 under him. Now, non-executive directors, we have Michael Anderson, who is a non-executive chairman. We have Asanti, we have Alexander, we have Evelyn, and we have Samson. Why is this important? Because for a listed company, for a quoted company like ours, having equal number of executives and non-executive directors is important, because one of the rules of good corporate governance is a balanced board. So for my company, if I take an overall view now, if we look at the structure of the organization, we can see that the corporate governance code has been honored in terms of the balance of the board. The board is made up of equal number of executive directors and non-executive directors. So good. Secondly, there is the CEO and the chairman are two different people, which is also good, which is also part of the code, because we don't want one person to control everything, right? So CEO and chairman is different roles. The only thing which there is no mention about is an audit committee, remuneration committee, nominations committee, risk committee. Nothing about this has been mentioned, and its membership. Generally, non-executive directors come together and form an audit committee, a remuneration committee, nominations committee. But none of that has been mentioned over here. So if these committees do not exist, we must look at setting them up. As in accordance with the UK Corporate Governance Code, listed companies must adhere to the same. It's good practice to have an audit committee, remuneration committee, nominations committee, and risk committee. Nothing has been mentioned. So further, if you want to make your structure of the organization strong, this can be a suggestion that we keep in mind. Now over here, after that, they have given us the value, the business model rather, or how the business functions has been explained over here through this diagram which is on your screen. So we'll deal with that because it's important to understand the business model. And the pre-scene says that our business functions using these four, or the business model is defined by these four boxes over here. So firstly, how does our business define value? Happy Playz defines value in terms of the choice that it offers its customers. So this is true to our aim of always having the right toys at the right time with customer focus. That's why we hold this inventory. That's why we have a good buying department. So our major aim is to offer choice to customers. Happy Playz aims to offer a wide selection of existing and desirable toys as well. So remember, defining value is important for a business because only then you can understand how you want to serve your customers. So I want to serve my customers by having choice, by having wide selection. Next, how do we create value? Happy Playz maintains a close relationship with toy manufacturers. Customers can visit their local Happy Playz shop in knowledge that they will have the latest and the best choice, as well as popular classics that they can choose from. So because of us having a close relationship with toy manufacturers, we are able to secure inventories of the best toys and popular classics. How do we deliver this value? Happy Playz has a sophisticated inventory management system that enables it to have the latest toys available for sale from its shop and its website as soon as they have launched. So good inventory management system is also our core competency. And last, we capture this value by selling the product. So Happy Playz shops are attractive and relaxed places to visit. Shops are located in convenient retail parks, and Happy Playz staff are trained to engage with the shoppers to make sure that they go ahead and complete their purchase. Costs are controlled through operational efficiencies in its stores and logistics. So what we are seeing over here is like a summary of the entire pre-scene and the summary of our company. What do? We define value in terms of choice, offer choice to customers. Secondly, maintain close relationship with toy manufacturers. Then we have good inventory management system. Then we have good relaxed environments in our shops. So this is our business model. You have to stay true to the same. So our P2 topics of how value is generated, how value is analyzed, how we engineer value, and the Porter's value chain come into the picture here. And remember, any business, if it wants to succeed, has to stay true to its business model. Now remember, I'm giving you this analysis not it's part of the pre-scene, that is why we are analyzing it. Secondly, I'm giving it to you so that you can take good ideas, so that you can understand good you can have good ideas with you when you go to mock writing. When writing your answer, if you start your answer by saying, we capture residual value by having a good attractive shop layout. That's why layouting is very important. For example, if it's relevant to that question, if you include something like that, it completely changes the examiner's perspective. And this will not come to you if you have gone through the pre-scene only once or twice. You have to go through it 10 times, 12 times, 15 times before the date of the exam to know what your company does, what the business model is. So when the time comes, you'll automatically be able to replicate it in an easy, simple way. But for that, the work has to be put in to keep going through the pre-scene again and again and again and again. That's why it's given to you as a video recorded explanation, so you can flexibly keep going through it. So remember, taking ideas from the pre-scene is very important, and that will only come if you keep going through it again and again. Now, what are the past questions that have been tested in this zone? Because obviously business model related questions do come up, right? So what are some questions which I feel can come up or have been tested? Firstly, digital technology in our ecosystem, understanding our business model and suggesting digital upgrades, how digitally you can make your business forward, how digitally you can enhance your business, obviously can be asked. What is a digital ecosystem? Which does your company follow? This is straight from E2 syllabus. So I'm giving you thought areas from the very, very onset. Next, Happy Playz's business model depends heavily on the ability of its buyers to identify popular toys at an early stage in their development. So only when they're developing, while they're being developed in their prototype stage, the buyer should have the experience that they pick it up. Not all the new toys that are launched each year are commercially successful. Happy Playz buyers must choose toys carefully. Otherwise, the company will be left with inventories of slow-moving products, which will eventually be a loss for us. So the job of a buyer becomes ever more important here. Unfortunately, Happy Playz's buyers must also be careful not to be overcautious, because some new toys prove to be hugely successful, often unexpectedly. You never know. There might be a huge spurt in demand because of any reason. Once or twice a year, a newly launched toy becomes so popular that retailers struggle to buy sufficient inventory to keep up with demand. So having the right and experienced buyers in place could be seen as a comparative advantage for our business, like I have mentioned before as well. Manufacturers may have long lead times. It may take 2, 3, 4 months for your order to be shipped and come to you because they come from overseas. So there could be a scenario where we buy an overseas subsidiary as well to handle this logistics, or to take, like I mentioned in the transfer pricing scenario, we buy an overseas subsidiary for taking the orders in an overseas country and then transferring it to Happy Playz. So buying of the overseas subsidiary means there will be a different currency in your consolidation. So IAS 21 and consolidation both could be tested simultaneously over here. Now, failing to have such toys on sales creates a huge opportunity cost. If you don't have it, the customer will go elsewhere and buy the same product. He doesn't care where he buys from, especially if they are popular during the fourth quarter holiday period. So it also leads to reputational damage for specialist toy retailers, because customers generally expect to find the latest toys in their shops. So your relevant costing topic comes into the picture here. If you don't have the relevant products, it's as an opportunity cost that you are incurring. Happy Playz buys most toys in sufficient quantity to obtain large discounts from manufacturers. You need to make your own margin the most. right? You want the most margin for yourself. So you have to buy in bulk so that the price is low and so that you can earn for your business. Unfortunately, non-specialists such as supermarkets can also obtain low prices because they buy only one range or two ranges, but they'll buy in like a huge quantity. For example, if Walmart buys a certain toy, they're not going to buy 5, 10, 15, 20, 100. They're going to buy thousands. So they'll have a lesser range, but the quantity they'll buy in is going to be huge. So they get a better price. But your advantage is you offer variety. Non-specialists can only afford a limited shelf space for toys alongside their normal products. Happy Playz aims to match competitor prices. So they're speaking about our pricing strategy over here. Note this very carefully. So we don't want to undercut them, but we want to match their price. If they're selling at $10, I sell at $10, not at 9, not at 8. I'm not starting a price war, but I am matching the price. So what does price matching mean? I've given an analysis for you. Now, companies use price match policies to improve their business operations and attract more customers. This policy is an excellent way to increase brand loyalty because customers will know that, okay, if I go to this shop, I will get the toy or the game at the best possible price. So it increases consumer confidence and boosts your sales as well. Now, although price matching strategy has many benefits, it comes with some downsides. For instance, Amazon is the biggest online company that does not offer price matching. Amazon does not match the prices. On the other hand, it focuses on aggressive repricing to stay competitive in the market. They'll maybe charge $2 more, $5 more, $7 more, but making sure that they don't cut their margins. So the cons of price matching are you lose out on your margin because Walmart might have bought a toy at $10 because they bought in a huge quantity. You might have bought it at $15. If you match to 10, you are making a $5 loss per product. So your margin might reduce because of the price match. This might also trigger a price war. If you cut to 10, somebody else will cut to 8, which is at the end of the day making the whole market suffer and everybody loses customers. So as of now, the policy of our company is to match competitor prices. That's our pricing strategy, and I've given you both sides of good and bad of this strategy. So what we are competing on is choice. We are not competing on price, which I've mentioned before as well. Our competition is based on choice, the variety that we offer. The need to match prices means that Happy Playz relies heavily on its purchasing department to negotiate the keenest, best possible prices. Negotiation is very important. The logistics department is crucial to managing inventories and maintaining our cash flow. Happy Playz frequently has to take deliveries of toys several weeks before it intends to put them on sale. It is important that inventory is subsequently delivered to shops ready for their launch dates. So an efficient inventory management system is also part of our business model, and it's one that is your core competency as well. The logistics department also analyzes inventory turnover, how quickly a toy is selling. Specific toys can be popular in one part of the country and not in others. Maybe in the north, a certain type of toy is selling. In the south of the country, another type of toy is selling. Logistics can often improve inventory turnover by relocating such toys to shops that have greater demand. Toys are unlikely to sell quickly are usually returned to Happy Playz's warehouse and then they are sold online at a substantial discount. My question again, do we have a data analysis system? How are we making these decisions? This toy is not popular. This toy is not popular. We might surely have some system, but is it a sophisticated system? If we have an inventory management software that our IT team develops or we get it developed by someone for our company, It can turn out to be an intangible asset for us. IAS 38 comes into the picture. Also, website management, store sales data, demand prediction is key for any modern business, and it adds comparative advantage. So your E2 and F2 syllabus, I've given you both outlooks over here. If you develop an inventory management software, could become your intangible asset, which is invaluable for your business because of the nature of the business. Next, the layout of Happy Playz shops is designed to make shopping there a pleasant and convenient experience. Toys are grouped by category to make it easier. And like I told you before in the discussions, a layout of a store is very, very important, because without a good layout, your sales can be affected. Manufacturers supply toys in packaging that can be stacked or hung from a retail display so that they can be browsed and handled safely before purchase. Happy Playz devotes as much floor space as possible to shelves and racks of toys, because remember, you deal, or your competency is to offer variety. The shops are all large warehouse type retail spaces, and Happy Playz has equipped each with shelving systems that are easy to install, remove and reorganize. So you can reorganize when you see a certain product is selling, not selling, you can reorganize. Happy Playz shops are located in retail parks. We know that. Customers find these locations convenient because you can easily reach them. And if you're buying a bulk item like a cycle, or you're like, maybe a bigger version of a toy, then you can easily access it because there's no, traffic or anything of that sort that you have to deal with. Happy Playz staff recruitment and training place considerable emphasis on enthusiasm and personality. We know that HR is very important, because if sales employees are not enthusiastic, if they don't have a good friendly personality, how will the product sell in the shop? So interviewees are asked to describe their favorite childhood toy and explain why they loved it, to judge their enthusiasm, to judge their personality to be friendly or not. So over here they've laid out the business model of Happy Playz again. Now we go to the financial analysis part. We analyze the financials of our company that have been given in the pre-scene, and we analyze also the financials of a competitor that have been given in the pre-scene itself. We'll analyze everything step by step. Now this financial analysis has been created by us, obviously specifically for this case study exam. So we will not ask you to do any extra research. We will not ask you to do any extra analysis, because it's been done by us. You will have to make sure that you go through the same and follow the same. We don't want you to dig in and calculate all the ratios and all the analysis and everything again. I don't want you to do that, because this is something that we have already done for you. Your job will be to make sure that you go through it. Your job will be to make sure that you absorb it, because the analysis has already been done by us, which I'll show you. So the first thing that we will do is we will look at absolute numbers, which means first we will look at the exact statement of profit or loss, statement of financial position, statement of changes in equity that has been given in the pre-scene. Exactly the same. A screenshot of that has been put over here for you. We'll read through, we'll see the trajectory of the business, and then I will give you a financial analysis, a ratio analysis, a percentage analysis as well, to help understand our company in a better way. So I have done everything for you. Your job is to make sure that you follow it very carefully. So please make sure that you're on board with me and nobody's distracting you at this moment, because going through this will be important. So firstly, we are looking at the Happy Playz group consolidated statement of profit or loss, which obviously means it's a group, which means they have already acquired some companies. We're already presenting a consolidated statement. Let's look at the numbers. The revenue last year in 2020 rather was 850 million. In 2021, it came up to close to 906 million. Then there is the cost of revenues, the cost of sales, if that's how you want to put it. If you look at the increase in revenue, it was greater than the increase in cost of sales, which clearly means that there will be an increase in gross profit. Revenue went up, the cost of revenue also went up, but at a lower percentage, at a lower number, which gave me a healthy gross profit. From that, your admin expenses have pretty much remained the same. Selling and advertisement expenses also in the same region, same ratio. See, when you look at it as 136 million to 140 million, from 2020, it was close to 137 million. 2021, it became 140 million. So it's an increase of 3 million, but when you look at it in conjunction, you'll see that it's not a huge increase. It's in the same bracket, it's in the same range. So nothing drastic that is happening. And you'll see that we spend a huge, significant amount on selling and advertising, because obviously that's our major expenses, right? We are a service organization. Marketing, advertising is very important. And because the gross profit had gone up and the admin and selling expenses remain in the same zone, we made a good operating profit as well. The finance costs went up a little bit, which means either more debt was taken and hence you have to pay more interest, or the debt was refinanced, which means earlier the let's say interest rate was 5%, now it became 6%. So your finance cost went up. There can only be two reasons for finance cost increasing. When we go deeper into the pre-scene and we look at the financial position statement and we look at the balance sheet, we'll see the actual position of borrowings and we'll understand why the finance costs have gone up. For now, let's know finance cost went up and there can only be two reasons, either more borrowing or either increase in interest rate percentage. Then there was an increase in profit before tax. Then the tax also increased. Obviously more revenue, so more tax. But over here we are a local company. We are only dealing in one country. So hence the tax rate of this country is what we'll apply. West area is what we'll apply. And if it was a global company, then there could have been the discussion of making money, or we could have made money in a country with a higher tax rate. That's why tax went up. But that has nothing to do with us, because we are only selling in West area. So we made a higher revenue, we paid a higher tax. And the profit for the year also showed a good increase. Now, when we look at absolute numbers, we can see that we are a huge company approaching the $1 billion mark for revenue. So we are a very big company, and looking at the financials currently in a strong position as well. So like I told you, the first thing that we did was we looked at the absolute numbers. Now I'm taking you to my analysis. What happens is, why we create this analysis, there are two reasons. The first reason is obviously percentage is easier to understand. But the second hidden reason is, do you think it's going to be easy for you to remember? For example, if I ask you to remember our revenue at 906.4%, if I ask you to 906.4 million, if I ask you to remember that, do you think you'll have to very mechanically try to memorize it? And I don't want that for our students. That is why we have created percentages for you. You can start your answer or end your answer when you go to mock questions by writing, or whenever in your writing you can include saying that our revenue has gone up by 6.5%. It's a good increase, but if we want to keep growing, we may have to look at diversification, expansion. For example, I'm saying this is how you can use these percentages and really enhance your answer writing. Take your integrated answer writing to a completely new and different level if you include these percentages. It's as simple as that. So rather than making you remember absolute numbers, rather than making you remember the exact numbers, we converted them to percentages for you so that you can easily understand them. So our revenue has gone up by 6.5%. Cost of revenue went up only by 5.27%. And hence there was a very healthy increase in gross profit. So gross profit went up by close to 10%, a good sign. Admin and selling expenses, like we spoke, they've remained in the same zone, not too much of an increase, so 2.4%. But because revenue went up, admin expenses remained less, selling expenses remained in the same zone, your operating profit went up by a very big margin of 20%. Finance cost, again, I will say not huge, but okay, 6.4%. And overall, the profit before tax showed a very healthy jump of close to 23.9%, which is very good for any business. And the margins as well for us are close to 8.59% in this current year. I'm talking about the final profit after tax margin, which is a good thing, because for a retailer, margins is where all the game is, right? Now, everything that I spoke has been put as a worded analysis for you over here. So our revenue grew slightly. Revenue went up, but the cost of revenue also grew, but by a lower percentage. Hence, gross profit was healthy. Interesting to note that admin and selling costs actually increased, but negligible. Very little increase in expense increased our operating profit by 20%, which we spoke about. Finance cost went up. I told you the two reasons for it. And the profit after tax and operating margins have increased in 2021, showing that the business is on a positive trajectory. So as you can see, a detailed financial analysis has been done over here. Your job is to simply go through it. No extra analysis. Why could have revenue gone up? Think that. Why could cost of sales go up? Think that. Think of reasons of why this could happen, that could happen. That's okay. But don't sit and calculate anything, because it's not needed. So the first thing, these financials help you understand the current position of our business. Secondly, you can use these numbers. You can remember some of these numbers. You can remember some of these percentages that I have put over here for you. Maybe you can remember increase in revenue. That's why I put it in red. Maybe you can remember increase in operating profit. Just a couple of numbers here and there, if you try to keep in your mind, not learn them, but keep going through the pre-scene again and again and again. So these numbers will automatically fit in your mind. And then when you use it, when the time comes, when we go to mock writing, it changes the complete perspective of the examiner who is checking. He knows that this student spent the time on the pre-scene, spent the time on analyzing these numbers, knows what these numbers are. He'll be able to really add, be in a good zone while checking your answer. So please make sure that you go through this analysis that we have created for you. Next, they have given us the consolidated statement of changes in equity. The consolidated statement of changes in equity is also part of your F2 syllabus. So for understanding this, you will definitely have to revise that topic. But let me go through this with you. While looking at the consolidated statement, you will see that the balance is the retained earnings and the share capital that was brought forward. Profit for the year is added. Dividends are subtracted. And then there is a balance at the end of the year. The most interesting thing to see over here is out of the profits that you made of 77 million, you paid out 74.2 million. This brings the dividend payout ratio to 96% of the current year's profit. This tells me, now let me put a scenario in front of you. If I am planning for a big purchase or a big expansion or a big, diversification, I will obviously want to build my reserves, right? I will obviously want to build the reserves in the company, the retained earnings in the company, and the cash position of the company. Majority of the profit that was made is paid out, which clearly means that as of now, the company might not have any positive NPV projects on the horizon, and that is why it's paying out most of its profits. It's not building and it's not holding huge reserves or making huge reserves at this moment. So it might not have any big huge expansion plans at the moment, any big huge positive NPV projects at the moment, and that is why majority is being paid out. It can be seen as a good thing because dividends encourage shareholders to invest in the business. But it can also be a bad thing because maybe the business is losing out on ideas of expansion. Maybe the business is losing out on the opportunity to grow. Both aspects need to be kept in mind. Because of such a high dividend was paid, only a negligible amount of profit was retained, and hence the balance of the year increased only slightly. Whatever profit you made, majority you paid out. Now we have the Happy Playz Group financial position. We have the balance sheet or the statement of finance position, whatever you want to call it. If you look at this, we'll look at it item by item, and then obviously I'll give you an analysis also for this. So non-current assets, intangible assets remained the same. No change in intangible asset, no new intangible assets, and no amortization as well. Next, property, plant and equipment increased a little bit. So there can be two reasons for the increase in property, plant and equipment. First can be new property, plant and equipment bought. Second can be the increase in value of an existing property. So the revaluation maybe process was done and maybe the value went up. That is why a book change was made as well. So intangible assets may remained the same, and the property, plant and equipment increased slightly. Current assets has gone down. If I look at inventory, from 58 million, 56 million it's become, but same range. Trade receivables, 17.6 million to 20.1 million, same range. Bank also same range. No drastic changes in the statement of financial position as well. Looking at the equity side now, we looked at the asset side. In the equity side, the share capital, share premium remained the same, which means in this year, no new equity was raised. We are a listed company, so we can raise equity, right? But no new equity was raised in this year. Retained earnings have pretty much remained the same because whatever profit we made, we've paid out. In the non-current liabilities, we have lease liabilities since our head office, our warehouse and our shops, everything is leased. So the non-current lease liabilities is 236.3 million. And from last year, this has gone up by a good number, I'll say, because from 224 to 236 is close to a 12 million increase in the lease liabilities. Means that maybe in this year a new lease was taken and hence a long-term liability created. Secondly, there are current liabilities, trade payables, same zone. Lease liability, okay, same zone. Tax has gone up, which we know maybe because the revenue was more. And that brings me to my total equity. So any significant change is not present in the equity statement or in the asset side, but the only noticeable change, the real noticeable change, was the lease liabilities going up. Maybe a new lease taken, maybe a new shop opened. That could be the only, that could be one of the reasons. So we looked at the absolute numbers again. Now we look at an analysis that we have created for you based on this statement of financial position. The first thing that we have created for you is ROCE, return on capital employed. What is return on capital employed? It's a metric which investors generally look at before investing in a company. Because when I invest in a company, I want to know how much I can earn from it, right? How much I can earn back. So the return on investment is important. And the return on investment is healthy for our company and still increasing. 20% last year in 2020 was still good. It went up to 24%. So if I'm an investor, I'm looking to invest my money, Happy Playz is a good place to invest because it's giving me 24% returns on the capital being employed. For example, this was a situation that I put in front of you. So the ROC is calculated as the operating profit divided by the capital employed by the business. A good sign. Next, you have non-current asset turnover. The revenue divided by the non-current assets. How many assets are you using to generate that revenue? It's a good number in the zone of 1.67. Next, you have your current ratio and your quick ratio. I'm going to discuss about the current and quick ratio in a moment. Let's come to that. So return on assets has gone up because income went up. Assets have gone up by a very small percentage here. Let me go back to current and quick ratio now before I move on to gearing, and I'll scroll down to the analysis part. So the non-current asset turnover is an important ratio which tells us how a company earns revenue per dollar investment in a non-current asset. It has slightly increased in the current year. So if I look at my business, if I invested $1 in my business, I got a return of 1.67, which is a good sign, right? Assets are being used well to generate the revenue. Now coming to current and quick ratio. Now the entity's liquidity position is one that is in concern, is bad. Current and quick ratio measures the liquidity position of the company. Ideally, a ratio over 1 indicates that a company will be able to fulfill its current obligations by selling its current assets. If something happens, I can sell my current assets, or I can convert my current assets into cash and pay off my current liabilities. But ours is below 1. So if something happens, we might not be able to pay the current liabilities until and unless we take a loan or we have any kind of outside help. Hence, the liquidity position is one of concern since it is less than 1, which means the company does not have enough funds to meet its short-term liabilities. So one which is of concern, which is the current ratio, and quick ratio, which for any retailer is very important because your cash cycle should be maintained. You don't want to invest lots of money in you don't want lots of money to get stuck in your receivables. You don't want lots of money to get stuck in your inventory. So financing will be very important from the F2 syllabus, and this further points out that this problem of how to deal with equity, how to deal with debt, how to raise equity, raise debt, options of raising equity, raising debt are important from your F2 syllabus. That brings me to the last ratio, which is gearing, which is close to 0.50, which is 50% of my capital almost is from gearing. 50% is from equity. 50% from debt, 50% from equity. Gearing indicates the financial leverage that is used by a company. Happy Playz uses a considerable amount of leverage. The number has pretty much remained the same, but we calculate gearing as debt upon debt plus equity. To make it more realistic, we calculate it as interest bearing debt, short term and long term, divided by equity plus interest bearing debt. Same. So debt upon debt plus equity. That's how we calculate our gearing. Now if you look at gearing at 50%, it's quite significant. And many businesses or many investors treat high gearing as a sign of risk, because majority of the money is taken from outside. What if a loan giver recalls his loan? What if the credit rating agency decreases the credit rating of this company? What if the interest payments increase? So high gearing can be risky. Now, because we have done this statement of financial position analysis, it is important for us to remember what the position of the company is. And the position of the company is, if we want to raise new capital, equity could be suggested, because you don't want to increase the gearing above 50%, because then signs of risk really start to come into the picture and can harm the reputation of the business. So suggesting further debt for the company could not be a sound suggestion. The sound suggestion would be to suggest equity, so that there is a good balance maintained at 30-40% of debt and 60% of equity. That's suggested. But yes, many businesses have a 50% gearing ratio as well, like ours does, because gearing is said to be cheaper than equity in most scenarios. But not when debt is at the highest percentage of 50, 60, 70%. The benefit of debt starts to really decrease. So a good capital structure is very important. And when our business wants to expand, equity could be one that you suggest. If you keep suggesting debt without knowing the financials, then it just questions your business ability. It just questions your business skill. We don't want that to happen. And that is why this analysis is done by us for you, so that you suggest well when the time comes in the exam. So this is very important. Please make sure you go through it carefully. Please make sure you understand this carefully and go through it again if you want. Now we go on to the segmental analysis that they have given, or a segment research that they have given. So they tell us that the revenue from traditional toys, the categories that they had explained at the very beginning, remember? The plush toys, vehicle toys, electronic toys, all of that, action figures, from 2020 to 2021 has gone up by a good number. Video games also gone up, bicycles also gone up, and that reflects the revenue increase for my business in this year than last year. But the major change has happened in traditional toys. If I look at the operating profit, for the operating profit, I can see that majority of the profit was developed or was generated from traditional toys, because it's the largest segment, then video games, and then bicycles. But in terms of profitability, if I look at it, in terms of profitability, traditional toys only gave me a profit margin of close to 12.4%. Video games gave me 18.9%, and bicycles gave me close to 28% of profit. So which clearly means that I should more focus on video games, have focus on bicycles. Yes, keep selling your traditional toys, but increasing your inventory of bicycles, increasing your penetration of video games will be important, because they are generating good margins for you. So through this segment analysis, I know that if I keep offering complementary products like bicycles, like video games, it can be profitable for the business. So keep thinking about new products that a toy store can offer. You're selling bicycles, start selling bicycle gear. For example, some bicycle gear. You're selling video games, start selling video game accessories, some video game CDs. Whatever, just keep trying to increase your business's inventory. So, because that's where the profits are, keeping on increasing your offers, your varieties, so that more and more customers buy. Keep this in mind, as bicycles being one of your more profitable products, video games being another profitable products, and yes, traditional is your largest category size, but the profit is good. but not as great as bicycles, not as great as video games. It doesn't mean that you stop selling traditional toys. No, that's your major business. 800, I think it was close to 781 million of revenue is coming from there. So it's your largest market share, yes. But try to keep increasing on video games. Try to keep increasing on bicycles. That could be our next step, next target, to keep increasing our offerings in video games, in bicycles. Next, we go to Gleat Hill's annual report. They're giving us very, very detailed competitor analysis now. They're giving us very, very detailed competitor knowledge now. Obviously, competition is very important in this industry, and it's further evidenced by the importance they've given to it by mentioning the entire competitor's statements in your pre-scene. So we'll go through it. Now, Gleat Hill and Happy Playz are the only major toy retail chains in West area. Gleat Hill has 150 shops, which are retail parks. You have 120. So Gleat Hill is bigger than you in terms of shops. Gleat Hill shops are generally larger than Happy Playz's shops, and more space is set aside for the display of new toys and large items, such as outdoor toys including swings and playhouses. So maybe a segment that Happy Playz can also look to entering. We want to keep increasing our product offering, right? So maybe we can look at outdoor toys as well, like swings, like playhouses, like Gleat Hill is. Gleat Hill is also based in West area and is quoted on the stock exchange. Now this is a very clear situation of brand competition and fierce competition, because you are selling the same products to the same customers at the same price. So competition is going to be, one that needs to be revered. It's called brand competition. The only difference is two different brands. They're selling the same thing. So competition analysis, external market analysis will be very important for this entire market, for us also to look into. Because if you don't know what your competitor is doing, if you don't know what your competitor is going to do, you may fall behind. And the same way we did the analysis for our company Happy Playz, we'll do an analysis of Gleat Hill's report as well. So let's start with Gleat Hill's financial reports. Okay, so in a different way now, for the analysis purposes, I've moved my video from the right hand side to the left hand side, just to make it a little bit more easier for us to relate, just to make it a little bit more easier for us to make sense of the things that are on our screen. So to make a comparison, I'm now showing you Happy Playz's financial statements, which are on the top left hand side, and then Gleat Hill's financial statements, which are on the bottom right hand side. Sorry. So we look at Gleat Hill's statements, and then for a comparison purposes, I've put the Happy Playz's statements here. So let's look at Gleat Hill first. In terms of revenue, Gleat Hill is bigger than us. They're close to 1.35 billion in revenue. We are 0.9 billion. So we are less than them in terms of revenue. And it could be because they have more shops and they have more product offerings than us. They also offer outdoor products. But if you look at Gleat Hill's revenue from 2020 to 2021, you will see it has gone down. So their revenue has reduced, where my revenue is increasing. So in terms of revenue, we are in a stronger position because mine is increasing. I'm probably offering the goods that people want. But Gleat Hill is a bigger company than ours in terms of revenue. Then you look at cost of sales. Their cost of sales significantly have gone up, close to 50 million. Cost of sales has gone up and the revenue has declined. So their gross profit is naturally going to decline. Our gross profit is less than them, but our gross profit is increasing. Their gross profit is declining. Their admin expenses are more than us. Their selling and advertisement is more than us. Their operating profit is more than us, evidenced because their revenue is more than us. Finance costs are more than us. The tax they paid is more than us because again their revenue is more than us. Then the profit is more than us as well. But if you look at their numbers, comparing it to their last year, it has gone down drastically. Costs are increasing, revenues are decreasing, and profitability is decreasing. So it's a worrying sign for Greet Hill. When you compare it to our statements, everything for us is pretty much positive. Everything for us is on the upward trajectory. For them, it's on the downward trajectory, even though they are a bigger company than ours. So maybe they are not able to control costs. Maybe they are not able to understand costs like we are. So from competition perspective, we can say that we are in a good place because of our increasing nature of revenues and good control of costs. That's what we understood here. Same way, so you remember I had provided an analysis for you in my pre-seen document. First while making this discussion, first we looked at these absolute numbers. Then I had provided the analysis for Happy Playz to you. Same way there is an analysis for Greet Hill for you in the pre-seen document, which you can go through. It says the same stuff which I have just discussed with you, but in percentage terms. I'm going to be discussing a comparative statement which we have prepared with you deeper into the pre-seen, but now let's only look at absolute numbers. So in terms of absolute numbers, we are in the right place right now. Next, we look at the balance sheets. While looking at the balance sheets, left hand side is Happy Playz, right hand side is Greet Hill. We've already gone through Happy Playz, let's go through Greet Hill. Their intangible assets have remained the same. Their property, plant and equipment has also increased. So maybe they made an investment, or maybe there was a revaluation that occurred. Their inventory went up, payables went up, bank balance went up slightly. If you look at equity, they have not raised any new finance in this current year, from 2020 to 2021 rather. Their retained earnings have gone up, which could show that they have paid out less dividends. They have paid out a less percentage of the profits, and that's why more money is retained in the business. We'll see this when we go to the statement of changes in equity at the next step. But right now, this is what we read. The lease liabilities have gone down, but are in the same range as ours. So maybe it's market practice not to own shops, not to own warehouses, rather keeping them on leases. Trade payables and lease liabilities have gone up, and their tax payment has gone down a little bit in their current liabilities because their revenue decreased, right? So tax is also generally going to decrease. Now coming to the total equities and liabilities at the final step. So if you look in terms of balance sheet as well, in terms of profit and loss statement, we are on an upward trajectory. In terms of balance sheet as well, when we look at the numbers, now I'll show you the ROCE, I'll show you the ratios one by one in a comparative statement. You will see that we are still in a better position than our direct comparators, which is Greet Hill. So over here we have discussed the absolute numbers in the statement of financial position and in the statement of profit or loss for both companies as a competitor analysis. At the next step, we are going to discuss percentages, which I have calculated for you and created a comparative statement to make sense of numbers in the percentage form as well. So it's a very thorough understanding that we give you. One is we give you the absolute numbers first. Two is we give you the analysis which we create. So hope you've understood this and hope you followed me. Now we look at the consolidated statement of changes in equity. Only thing we look at directly is the dividends. Their profit was 139.4 million, reduced from last year. It went down. They still made a profit, but it's going down. Dividends are 48.8%, which means they only paid out roughly 35% of their profits. So they are building their retained earnings. Maybe they have a new plan that they're going to use. Maybe they have a new property, plant and equipment that they want to acquire. Maybe they have a diversification in mind because their revenue is going down. There could be many reasons of paying a less dividend. For us, we paid 96% out as dividend. They, on the other hand, paid 35% out. So in this year now, it will be very important for us to look at the steps that Gleet Hill takes. Because maybe they're building reserves. So what are they building their reserves for? Where are they investing the money? Where are they putting the money? An important eye will have to kept on Gleet Hill this year, because we want to see what they're doing of the reserves that they have built, of the money that they have invested in the reserves. And now I have a comparative statement of profit and loss that I have created. This is extra. We have created this. This is to give you the numbers in terms of percentages. And this is a clear evidence of what we have discussed. So statement of profit or loss first. If you see revenue, ours is going up, theirs is going down. Cost of sales for both have increased, but for us, revenue had gone up and that's why cost of sales has increased. For them, revenue has gone down and still cost of sales has increased, which is not a good sign. And hence we have a very healthy increase in profit and they have a very healthy decrease in profit. If you look at admin expenses as well, if you look at selling expenses as well, ours, if let's look at theirs for a very simple understanding over here. If you look at their admin and selling expenses, they have been shown as negative because maybe they didn't make a profit and that is why they want to cut their costs. Maybe they didn't make a profit and that is why they want to make sure that they save costs somewhere. So if you see, the admin expenses in 2020 for Gleet Hill was 11.8 and for us and for them in 2021 was 10.3. So maybe the profit reduced. That's why they want to reduce the admin. They want to reduce the selling expenses. For us, on the other hand, they've pretty much remained in the same zone of a 2%, 2.4% increase and not a huge thing to worry about. Next, operating profit for us went up by 20%. For them, it's gone down. Finance costs, I'll say, is in the same picture. For us, they have gone up 6.4%. Increase in profit before tax, for us, 23.9%. For them, a negative 6.3%, which again shows that we have been profitable in this year. We are moving in the right direction. But for them, it's a sign of concern. So in terms of competition, maybe we are on the upward path and taking away the market share from Gleet Hill. An important consideration, right? An important thing to be to take as a positive note for our business. Now let's look at the operating profit margin and profit after tax margin. If you look at their operating profit margin, it's a little bit higher than us, and profit after tax margin is also higher than us, which means that though their sales have gone down, they have maintained good margins. So profit after tax divided by sales gives me the profit after tax margin. And we'll see that even after their revenue taking a hit, their margin was maintained. So they're obviously a big player in the market. They know what they're doing. They've been in the market for a long time. You have to give that to them. And they are your biggest competition. So by looking at this comparative statement, you have a very clear understanding and very clear analysis that you are ahead of your competition in terms of prospect. But in terms of size, Gleet Hill is bigger than you. Now to the comparative statement of financial position. This is comparative. If you look at our ROC, it's less than theirs, but getting there, same zone, same area. So for an investor, it's not a very big decision to make over here in terms of the money where to invest. We are paying out good dividends, we are showing good profits. Happy Playz is the place to invest your money. Non-current asset turnover, same situation. Current ratio, quick ratio, same situation again, which tells me that maybe this is the nature of the market to have a very tight liquidity position, because everybody needs to hold inventory. Everybody has money invested in payables and receivables. So this could be the nature of the market, which gives me a little bit of a sigh of relief that I'm not the only one who could face liquidity issues. Our biggest competitor is also in the same zone. But one thing which is different is gearing. Their gearing is close to 40%. My gearing is close to 50%. So something that we will have to cut short on, that we will have to make sure we get in control, and any further investments or any further raising of finance happens in equity should be our priority. Now this was an analysis of the financial statements that we made for you. Everything in the financials was discussed. Everything was presented to you as numbers, discussed as full values as well. And we provided our analysis conclusions as well for the same. Your job is not to analyze anything extra. Simply go through what has been provided. And that brings us to the news analysis section. Now the news analysis section is the final section in the pre-scene, which we have already summarized for you and which we have already analyzed for you. A summary of the same has been created and an analysis of the same has also been created and put for you in one simple page. So that has been done for each article that's there in the pre-scene in the news analysis section. And we don't want you to do any extra analysis, any extra reading or anything like that. Your job is to simply read through it. Read through the analysis that we have created. That's all. Nothing else. No extra detailing, no extra analysis needed. It's been done for you. Just simply go through it. And with that, we will arrive at the end of the pre-scene and this 75-page document is completed. So let's make sure that this entire pre-scene that has been created for you, you go through it multiple times. So no stone is left unturned in knowing our company, Happy Playz. Make sure you also keep going through the financials again and again, so that it sinks in your mind and so that it remains with you and so that it's something that you don't forget. That's the end of the pre-scene. Make sure you use it well and keep going through it again and again and again.